Something new, something really important came out this week that I need to share because it's really dangerous, and it's something that you need to be aware of because if this crosses your plate, you need to see it before it happens. Both Uber and Lyft went public in the Uber last week and Lyft a couple weeks ago. Neither of them went very well. Neither of the offerings went very well. They popped a little bit at first, and then they sank like a rock shortly thereafter. So both of them are doing poorly, and both companies are crying foul that, hey, the way that the stock market rules work are penalizing us. It's not fair. We live in a world where everything is not fair. But here's the way that this works. There's about 10,000 public companies in the stock market environment, and all of these rules are subject to accounting rules called GAAP, generally accepted accounting principles. They're all subject to the same rules. And here's why these rules exist. Imagine if one company wrote down their financials and they said that we did it like this. And another company, so in other words, one company had a lot of receivables, they made some sales, but they didn't collect the cash. And another company made some sales, they did collect the cash, and they don't have any receivables. Well, to an investor, those things are different because those receivables may never be collected. So don't you think as an investor, you need to know the difference between those things? So generally accepted accounting principles force accountants to write down the differences that different companies have in the way that they're doing things. And that makes financial statements comparative between companies. So all accounting statements are always issued on an apples to apples basis. You don't have to worry that one company is doing it one way and another company is doing it another way. And that's really what CPAs study when they go to college. And that's really a lot of what the CPA exam is about, how to really measure these generally accepted accounting principles. And in fact, when auditors come out to companies to examine them, which they do every year, they're not only examining the financial transactions to make sure that the transactions are accurate and they're being represented properly, but they're also making sure that the way that they're written down, the way that the financial statements are organized, are according to these financial principles called GAAP. And there's no deviating from this. This is the way it works. So when you look at financial statements, you as a consumer should have absolute confidence that you're looking at apples to apples, that all companies are being measured the same way. So Uber and Lyft, and now a few of these other companies that are having their IPOs this year, are saying, hey, these rules just don't work for us. They just don't work for small companies like us because we have very high startup costs, and they're making us expense those very high startup costs. And when you expense those costs, that means that our net income is going to be less, right? So that means that our losses are huge because we're investing all this money. So they don't think they're spending, they feel like they're investing. And in a certain way, I kind of agree with them. Having been in the venture capital in the startup world for a long time, that money that they're spending to get started really is sort of like buying a truck, where that truck's going to last a long time. Well, those expenses that they spend, even though they're on regular things like personnel, programmers, computers, the things that they're buying and that they're organizing are going to last that company for a long time. Now, under GAAP, they have to expense those and they have to take a loss. But they're saying, well, wait a second, this is not smart thinking. This is not really working for us. So why don't we just call it, we capitalize it, in other words, keep it on our books for a long time, not subtract it against our income so that our profit looks higher. Well, as much as I think that probably has some merit, that's not the way that GAAP works. And a consumer or an investor would be confused if they saw one company doing it one way and not another way, because all companies need to do things the same way. Now, what Lyft and Uber are trying to do, they're trying to convince these investors on Wall Street, hey, you guys need to pump more money into our deal because it's much better than you think, because the way that GAAP does it is just not a good reflection for a company like ours. Well, GAAP works for everybody and everybody's subject to the same standard. But there are two different kinds of financial reports. There's internal ones and there's external ones. The ones that Wall Street gets are the external ones. And it's perfectly okay to have your internal ones be different than that. So if you want to have an internal measure or metric where you measure how you're doing in some different way than what everybody else does, internally you can do anything that you want. But externally, you have to follow the rules, because otherwise consumers would find themselves in just a world of hurt and they would not understand what's going on. And what creates the confidence in our financial system and in our stock market is that there's consistency and there's comparability between companies. And if you don't have that comparability, then how could you ever have an exchange where people are buying and selling against each other? So those are things that you need to think about for yourself, for your company. How are you plugging yourself in? Do you have these external reports against these internal reports? These are all things that really make a very big difference, and they're very powerful. And this is the way that you take this inside information, the inside track that we give you here, and you can profit from the inside. And that's what's great about this business. So go out and stake your claim.